Good evening, everyone. I'm Kate Thwaites. I'm the member for Jagajaga. Thank you so much for joining us this evening for this budget town hall. I'm on the lands of the Ngunnawal and Ngambri people here in Canberra, and of course in Jagajaga, you're on the lands of the Wurundjeri Woiwurrung people, and I pay my respects to elders past, present, and emerging. I am really pleased that we've got so many locals joining us for this discussion tonight. I think this is an important budget, and it's one that I've had some good local feedback about, including people wanting to give me their thoughts on parts of the budget, as well as ask some quite specific questions that we'll go through tonight. At its heart, this budget is really about opportunity. It is about making sure that we are ensuring that Australian promise of hard work and getting ahead, and most importantly, getting a roof over your head, is there for young people today and for the generations to come. And certainly for me, when I'm out and about in the electorate at the moment, the conversations I've had and have been having with people, and not just young people, but also their parents, their grandparents, is that they want to know that young people are going to have that future, that opportunity that has been there for generations in Australia is going to be there in the future. And that is really at its core what this budget is designed to help do, to help young people have that security of owning a home. I see that as good, not just for those young people, but also for our community as a whole. We are all better off if we have that promise and hope for the future across the community. There's also, of course, important investment in the budget more broadly for services in our community, delivering more housing, strengthening Medicare, expanding access to bulk billed GP appointments, for us locally, making the Medicare urgent care clinics in Heidelberg and Eltham a permanent feature and a permanent part of our health system. So that will be very important. Again, I'm really pleased that so many of you have been able to join us tonight. Some have already submitted questions as well. So look forward to getting to those. But before we do, it's really great that tonight I could have the Honourable Dr. Andrew Charlton MP, the Assistant Minister for Science, Technology and the Digital Economy, join us. Many of you would probably know Andrew by reputation. He has a very strong and long background in business and economics. He's someone who's a key part of our economic team here in Canberra and a great colleague to have. So Andrew, thank you so much for joining us tonight. And I'll hand over to you for a brief budget explanation before we go to questions.
Well, thank you, Kate. I really appreciate the opportunity to talk to some of our Labor members about this budget and what it means for them and answer any questions you might have. I'll make a couple of reflections. As Kate said, I have been covering budgets for a long time. Once as a advisor and for a while as an economist as well. And the one reflection I'd make is that not every budget is consequential. Not every budget is a budget that we'll look back on in years to come and go, that really mattered. But I do think that this is one of those budgets that is consequential. And the reason that I say that is because for me, a consequential budget is a budget that actually tackles the real challenges we have in our economy and in our country. And I think this budget does that. One of the biggest challenges that we've had for a long time is this very unusual difference in the way that we tax labour and capital. And to make that really simple, what it means is if you earn your income from labour by setting your alarm and going to work, receiving your PAYG tax, you'll pay a certain tax rate. But if you receive your income in almost any other way, from other than going to work and earning it from your labour, you pay a very different tax rate. If you're earning it from capital gains on shares that you have, or property investment that you have, or from the sale of a business, from superannuation, you pay a tax rate that can be half as high as the tax rate on people's labour. And that was a really big distortion in our economy that had a lot of different consequences. And one of those consequences is that it really made it hard for people to buy houses from their labour income because they were competing against investors. And the second problem we had was we had this capital gains tax system, which was really quite unfair to a lot of people who were trying to invest in long-term productive assets. And it created a distortion in the market, which encouraged investment in residential property and existing homes, but was actually quite a punitive tax on longer-term, more productive assets. And in the course of the discussion, I'll explain why that is. We have a couple of slides that have been prepared by Kate's team, which I think are really good. So I might go through some of those quickly. And this is just a kind of a background to some of the key issues in the budget. The first one here is the challenge that was caused by some of those tax distortions. We've had this really rapid rise in housing prices in Australia, rising much more quickly than full-time earnings. And the consequence of that is we've had a big reduction in home ownership, particularly amongst young people. We all know the stories of young people turning up to auctions and being outbid by investors. We can all see the stress on young people who are having to pay such a large amount and borrow so much money for their homes. And that problem was becoming worse and worse over time and really fueled by some of those tax problems that I was describing. So what are we doing about it? Well, in the next slide, we talk about one of the things that we're doing in this budget, and that is to limit negative gearing. Negative gearing was a big tax advantage that was available for property investors that was not available for first home buyers. And what we've done is say that if you want to take advantage of that big tax benefit as an investor, you can still do that, but you have to be doing that for a new build. You have to be adding to the housing stock. Because if we have more people adding to the housing stock, then we're starting to solve this big housing crunch that we have across our country and across our economy. So that's one of the changes that we've made to limit that negative gearing to new builds. If you have an existing negatively geared home, this does not affect you. We have grandfathered all of our existing negative gearing. But going forward, we're asking people in return for receiving that tax benefit that they contribute to the nation's housing stock through a new build. So that's the first change. The second change, which has been one of the ones that's been really controversial in the media, is changes that we've made to capital gains tax. And Australia had a really unusual capital gains tax system. So if you buy an asset and you sell that asset, the difference between what you sold it for and what you bought it for is your capital gain. And we tax that very differently to the income from your labour, as I said before. You used to get a 50% discount relative to your labour. So you're paying half as much tax on the income that you would receive from your capital than from your labour. And there are some good reasons for that type of discount. There are some not so good reasons for that type of discount. What we've done is replace the way that discount works. So we haven't taken away the discount, but we've made it what we think is a fairer and stronger type of discount. And let me just try and explain very briefly why we think the way that we're doing the discount going forward is better than what we had before. The old 50% discount, you got that irrespective of how long you held your asset for. So, for example, if you were holding a really long-term asset, you were investing in shares or a business, over the life of that asset, you were getting a lot of inflation. And you were having to pay tax on that inflation. And actually, if you were holding an asset for 20 years, for example, you might over the course of that time get 60 or 70% inflation, and you're paying a lot of tax on that inflation. And so it was actually quite punitive to long-held productive assets, but very generous to kind of shorter-term assets. So what we said is we're going to give you a discount based on the inflation that you have during the life of the time that you hold the asset, which effectively means that we're neutralizing how long you hold the asset for and making it a level playing field across different types of assets. So we think that's going to encourage more investment in sort of longer term productive assets. We think it's fairer. There will be a lot of people who pay less capital gains tax. There'll be lots of assets which under the new regime will pay less capital gains tax than under the old regime. That is not a fact that you get presented in the media at the moment very much, but it's true. Particularly assets which have been held over long periods of times, they'll be paying less capital gains tax under our regime. That gives you a benefit, a discount based on the inflation that you suffer. So we think this is a fairer system, and we think it's a system that is better for our economy. The next slide really makes the point about how these two things interact. So the combination of negative gearing and capital gains tax, two very generous tax benefits for property investors, has really caused our residential housing market to go haywire. And you can see here, it's really the price of housing, which is that yellow line, has really increased really rapidly relative to household incomes, which is that blue line. So for a long time in the 1980s, those two lines were very close together. Wages were going up and house prices were going up broadly in line. And then we see this tax discount introduced and bang, things really start to bifurcate. And that's when we started to really lose the promise, the dream of home ownership in Australia for young people who are earning their income from labour, turning up to auctions, and their taxes are subsidising the investors that they're bidding against. So that's the effect of these distortions in the market. I might run through to the slide here on small business, and that slide is an important one because there's been a lot of talk in the media about small business. I think a lot of that media commentary is really misleading. Small business is an incredibly important part of our economy. Half of all Australians work in small businesses. This is really the engine of our economy. And so there's a lot in this budget to support small businesses. We're giving them a big benefit to support new capital investment that they make, making a $20,000 instant asset write-off permanent. We've made some significant changes to the way that losses are treated. So to kind of even out lots of small businesses, one year they might have a good year, the next year they might have a bad year, the next year they might have an okay year. So they have a lot of volatility in their business. So we've done some things to smooth out the tax that they have to pay, which will be a real benefit to lots of businesses. And we've also provided all sole traders with a tax cut. So lots of advantages in this budget for small businesses, and something that this government, which is the sector that this government really cares about. So maybe, Kate, I'll pause there and jump into the questions.
Yeah, great. Thank you, Andrew. And many of you, when you registered for the forum, sent us through questions. So we'll go through some of those now. There is also a Q&A function as part of the session, so you can put additional questions in that. And if we have time, we'll get to those. But Andrew, we have a question from Matthew from Ivanhoe East. I feel very, talk show host here. We have a question from Matthew from Ivanhoe East, and Matthew asked, many Australians use rent vesting as a pathway into home ownership, buying an affordable investment property while continuing to rent where they want to live. How does reducing or removing negative gearing help first home buyers who are using this strategy to get onto the property ladder?
Very good question, Matthew. So just to kind of recap the issue here, the issue that Matthew's raising is an important one. He's saying, well, if you're trying to help first home buyers get into the housing market, some of those first home buyers are accumulating a deposit. They're working really hard to accumulate that deposit. While they're on the pathway to saving that deposit, they're often putting those savings into the stock market. If the effect of you taxing capital gains differently means that you're eroding some of the savings that they have, or they would have less than they would otherwise have, that could actually set them back. There are two really important things to note here in answer to this question. The first thing to note is, as I said, we're not necessarily increasing capital gains tax for exactly that type of person who's investing in the stock market. There will be a lot of people who are investing in the stock market who are better off under the new regime. So that's the first thing to say. But Matthew, I am not your accountant, but I do have some financial advice for you, which is that the government actually has a scheme specifically designed for people in this situation, which is much better than either the new regime or the old regime. That scheme is called the First Home Super Saver, and it is designed for people doing exactly what you are describing, which is saving money for a home deposit. And this scheme enables you to save money in an extremely tax advantageous environment, namely in super, and withdraw that. So you can put extra money into your super that is taxed very generously at just 15%. And you get a big tax offset on the other side of that. And you can withdraw that when you need it in order to put together a deposit for your home. So people who are investing in the stock market to save for a home deposit should really think about this alternative scheme, which is better than either of the alternatives we've been talking about and a really attractive option for young people trying to save for a home.
Thanks, Andrew. That's so true that I think that scheme isn't as widely known about as it should be. So it's one that certainly I should talk about more in Jagajaga as well. I think people are already using the Q&A forum. If you are popping questions in that for us, please also just pop your name and where you're from so that we've got that as well. But a question from Robert from Greensborough. Why did you apply a flat 30% tax on discretionary trusts irrespective of the net income amount? A discretionary trust with a net income of $30,000 will be required to pay $9,000 in tax compared to $1,888 tax paid by one recipient. This also adds administration to small to medium trusts. So quite specific from Robert there, Andrew, but again, that's part of what we're trying to address tonight.
Yeah, look, trusts are a really difficult one. And the point that you make is a fair one. I'll try and explain it to people, some of whom will understand trusts and some of whom will be less familiar with them. Some people hold income in a trust or hold assets in a trust that generates income, and then the trust distributes income. So a really common thing that people do is they might have a business, and that business is generating profit, and the business is owned by the trust. And so the profit from the business goes into the trust, and then the trust can then distribute that profit to the people who are called the beneficiaries of that trust. And in a family business, the beneficiaries might be the members of that family. And the point that Robert is making here is that we have changed the way that we tax trusts. We used to say if you are putting money out of a business and into a trust, for example, then there was no tax on the way through and you just paid, if you're the recipient of that money at the end, you just paid your tax on that. What we're now saying is that when the money comes out of the trust, we're taxing that money at 30%. But here's the thing, we are giving the end recipient of that credit for that 30%. So if your tax rate is 30%, then you will get and $100 is coming to you, then only $70 will come to you, but you'll get the credit for the 30% tax that's been paid and you won't pay any more tax. Or if your tax rate is 37%, then you will only pay 7% on the money that comes to you. So the money flowing through the trust is being taxed as it goes through the trust, but the end recipient is getting a credit for that. So they are not necessarily paying any more tax. But Robert makes a very good point though. If the person who is the end recipient has a lower tax rate than 30%, then they will be paying more tax. And the reason that we are doing that is because when we looked at the tax data, there were a lot of people who were holding that money in the trust and paying it to themselves in years when their income might be very low and their tax rate might be very low. That might be, for example, if they are having a year off work, or if they have recently retired. So there was an element of shifting the timing of money flowing through the trust in order to minimise tax rates. And so that's the reason for that 30% tax rate. It's not going to affect people who have a higher rate than that, which will be the vast majority of people with trusts during the period that they are earning income. But it will have an effect on people who have very low tax rates for different reasons, but are the beneficiaries of trust. I tried to make that as simple as possible, but I felt like it was a bit of a word salad.
You picked up on a lot there, and I think again you picked up on part of what hasn't been part of the media conversation really, which is exactly where that taxation comes through and how it applies on that individual level. And as you say, it is complex, but we do have another specific trust one. So I'm going to get you to go even deeper on this, Andrew. This is from Lachlan from Eltham, who said, I operate my business through a family trust for asset protection. How is it fair that it pays 30% tax before income is distributed to individuals and is taxed a second time? This equates to 62.9% tax on income. How is it fair that I'm taxed an extra $235,000? For some self-employed people like me, my business value is my super. Why do I now lose half of this?
Yes, so there are really two parts to this question. The first question is about double taxation. So we're back to the similar issue that we discussed with Robert. The good news for you, Lachlan, is when that, in the specific case you're talking about, where income goes through a trust, which a lot of people do. I had a very similar structure when I had my business, exactly the same structure as you're describing. There will be no change for you. You are not going to be double taxed. So you are not paying that 62% tax. The way this works is, as I said, you are going to get a credit for the 30% tax that the trust pays you. And so you will not pay that 30% tax twice. There has been a bit of misleading information in the media around this because in your specific case, your question says, if you pay 30% tax before income is distributed to an individual, it's taxed a second time. That's not the case. The reason why some people have been confused is if you are distributing the income from your trust to a company rather than to an individual, then the company does not get that credit. But in the specific example you described, you are getting that credit, so you are not being taxed twice, and you should be paying, as long as your personal income tax rate is greater than 30%, you should not be paying any more tax. So that's the first point, which hopefully puts your mind at rest. You will not be double taxed in the scenario that you describe. The second part of your question is about the end sale of your business. As you say, and a lot of people feel this way, my business is my superannuation, it's my retirement. People pour their heart and soul into their business, and they often pay themselves not very much on the way through as they build that business. And one day they want to sell that business, and that's going to be their retirement. And there've been a lot of memes running around the internet suggesting that the government has increased the tax rate to 47% and Anthony Albanese owns 47% of your business. Those memes are just very, very wrong. We have not increased tax to 47% on businesses. In fact, we haven't even changed the tax rate at all. A couple of things to point out. First of all, for small businesses, there are a lot of exemptions that mean that often many small businesses won't pay any CGT at all. If your business is a small business, if you have owned it for more than 15 years and you are selling it into your retirement, as you describe, we have a full CGT exemption. Let me make that clear. You will pay no CGT at all if you satisfy those requirements. So in the situation you describe, where a small business is being sold to provide for your retirement, it's your super, as you say, you might pay zero CGT, which is a really attractive way, for you to realise that superannuation value or retirement value that you want. The memes are not, on top of that, the memes are not correct. There's no 47% new tax. That just does not exist. All that's happening is what I said before. Previously, when you sold your business, you whatever that gain you made, you were going to pay your marginal tax rate on that. Whether your marginal tax rate was 30 or 37 or 47, you were going to pay that marginal tax rate. Exactly the same happens. It's just that gain used to be reduced by 50%. And in the future, that gain, instead of being reduced by 50%, will be reduced by the cumulative inflation that you've suffered. So there's no change to the tax rate. It's just a change to the way the discount is implemented. For some people, that will be better. For some people, that will be slightly worse. In your case, I'm hoping from what you've told me here, you might be able to take advantage of those CGT exemptions, and you're in a really good situation.
Thank you, Andrew. Again, that was a complex one, but you really stepped us through that. I've got a couple of broader ones now, actually. So Jim from Rosanna has asked, why were the new CGT rules applied to most assets rather than just investment properties?
Yeah, good question, Jim. A lot of people say, well, if this is all about housing, why have you put the CGT on different asset classes? Why have you put it on shares and other things? Well, it really comes down to what I started to talk about at the beginning of this call, which is we haven't taken away the CGT discount. We haven't increased the CGT tax rate. In fact, there's no such thing as a CGT tax rate. You just pay your marginal tax rate, always have or always will continue to do. We've just changed the way that you get a discount on the CGT that you pay, from being a 50% blunt discount to a discount that's based on inflation. So the reason that we've done that for all assets is we think it is better for all assets. As I said before, that blunt 50% discount was super generous in some cases and actually not very generous at all and quite punitive in other cases. And it was punitive particularly for the type of investment that we want to encourage, sort of long-term investment in productive assets. So a lot of people who own shares, for example, if you owned one of the most common types of shares, an ASX 200 ETF over the last 10 years, you would be about the same, if not better off under the new regime, because the capital gain that you have made and the inflation that you've suffered will mean that the discount that you get under the new regime will be similar, if not slightly larger than the discount you would have got over the last regime. So the important thing to say here is we're not whacking a new tax on other assets. We're not even necessarily increasing CGT on other assets. We're changing the way CGT is calculated on all assets. Some people will pay a bit more, some people will pay a bit less, but overall we think it is fairer and we think it is better for our economy and will encourage more productive investment that benefits us all.
Excellent. Now, this is going to sound like I set this up, Andrew, because that was Jim from Rosanna, and I now have one from Tim from Rosanna, but I assure you I did not set this up. Tim has used the Q&A function for us tonight, and he's asking, with a large shift from investments in single assets into ETF broad range investment, was that taken into account when the CGT was redesigned?
If I understand your question, you're saying, there's obviously been a big shift in the last 20 years from people investing in single shares to investing in ETFs. And does that make a difference to the way this tax works? I don't think it does. As I said, that the example I gave you of the ASX 200 ETF, that's a good example of a very common type of investment in the stock market, which is going to be about the same, if not better off, under the new scheme. So I think if I'm understanding your question correctly, and I apologise if I'm not, I think that ETFs will work fine under the new scheme. You'll get the benefit of discount that's calculated on the inflation that you experience over the life that you hold that ETF. And depending on the circumstances, you might pay a little bit more or a little bit less. But I think, we'll encourage people to hold those assets for the long term. If you were holding an ETF for a long time under the previous regime, you could be quite punitively taxed because you're not getting any compensation for the very significant amount of inflation that you're accumulating over that long period.
Right, excellent. Please do continue to use that Q&A function and get your questions through to us. We are actually doing pretty well for time, which is great. Andrew, we've got a couple of ones that go to other measures, broader measures in the budget as well, which I thought with these ones I might provide a bit of an answer, which you may also want to add to as well. The first of those is John from Eltham, who's asked, how much does the government save by removing the private health insurance rebate for older Australians, given that it's likely to put even more pressure on the public hospital system? And John, thank you for that question. Certainly this part is something that I've had feedback from across people affected in the community about. So I'm aware, obviously, that of course private health insurance is something that's really important to many people in our community, including older members of the community. One of the things that I think it is important to remember here is not that we are removing the rebate, we are making the rebate the same level as it is for other people. So that there will still be a rebate in place, but it won't be as generous. In terms of pressure on the hospital system, obviously, it is really important that people can still access our hospital system. It is really important that people over 65 are still getting excellent health care. My understanding from talking about this with the Minister for Health and others is that all the data shows us that in general, it is not going to put an additional strain on the hospital system, because we will expect that people, given there is still a rebate there, will continue to have their private health insurance. I think the other part that's really important to realise from this is that the money or the savings that do come from this, together with other revenue, is being invested into our aged care system. And that is really important because obviously we do have an ageing population. We do want to make sure that the aged care system is fit for purpose. And again, that's certainly something that I get a lot of feedback from the community about. So those are the broad parameters around that. As I said, it is one in addition to some of the things that Andrew's been tackling that I've been having conversations with colleagues here in Canberra about. But Andrew, was there anything else you wanted to add on that point as well?
No, I think you described it really well, Kate. Something that we're ploughing every single dollar from that back into the aged care system, which is a system that really needs it.
It does. And another health-related one, Molly from Heidelberg. A lot of people are finding it harder to get a GP appointment when they need it and worried about the cost of seeing a doctor. Molly says she's seen on social media that Medicare urgent care clinics are becoming a permanent part of Medicare, but are they actually making a difference for people? And what is it that's making it easier for locals to see a doctor? A couple of points around that, Molly. Most people are probably aware that locally we have 2 Medicare urgent care clinics. We have one in Heidelberg in Burgundy Street. So obviously that is taking pressure off the emergency department of the Austin just up the road. And more recently, we've had one open in Main Road in Eltham. The one in Heidelberg is actually one of the busiest in the country. So late last year, we also put extra resources into that one so it could have more staff. So I think that goes to how well used these facilities are being used in the community. And of course, they provide that service where you're looking for that care that's urgent, but isn't at the level where you need to go to emergency. And hopefully, again, I think the feedback I certainly get from locals is that they are saving people that trip to emergency and that people are finding that a really useful service. In addition to that, one of the measures that we introduced last year was to put additional incentives in for GPs to bulk bill. Again, I get a lot of feedback locally from people who are concerned that GPs don't bulk bill anymore, that it is too hard to find a bulk billing GP. So this was really a measure that is designed to encourage more GPs to bulk bill. We have had, since that measure's been put in place, we've now got 15 Medicare bulk billing practices in Jagajaga, which is an increase in 8 of those practices since this change came into place. And that includes in West Heidelberg, in McLeod, in Bundoora, in Greensborough and Eltham. I think those numbers will continue to grow, and it's certainly something that I talk to local GPs about. I do talk to the community about, and that I have conversations here in Canberra about. I think it is a really essential part of our health system that we make sure that Medicare remains as a bedrock of it, and that GP access is part of that. Andrew, is there anything you wanted to add on that as well?
No, we have a in my.
We love talking about Medicare.
Yeah, I'll make one quick comment, which is in my electorate we have a really big hospital. I know you have big hospitals as well, and we've seen the number of presentations for those category 4 and 5 falling in our hospital ED because they've been diverted to the urgent care clinic, and that's a really positive thing for the people who need to go to emergency because they have category 1 and 2 very serious problems, and certainly the urgent care clinic in my area has taken a bit of pressure off the ED.
Absolutely. Another question that's come in through the Q&A, Martin from Yallambee, what have the outcomes of the 5% deposit scheme been, and has there been strong demand for it? What other supports have been available for first home buyers? Because there is a lot of information out there. And are there concerns young people are taking on larger loans? And Martin has also said, thanks for the opportunity to discuss the budget.
Yes, look, this is certainly another thing that we're doing to support first home buyers. And that is helping them with these 5% deposits, where the government effectively comes in and supports those first home buyers to purchase a home with a smaller deposit than they would require if they didn't have the government's support. This has been a really popular scheme. It's a scheme that I think has been doing very well. People have been taking advantage of it. They have been taking on debts, as you say, and often quite large debts because their deposit is small. But they've had a very good rate of repayment on those debts. All of those, the performance of that debt has been positive, so we're not seeing high rates of arrears or delinquencies from people who have taken on debts associated with that 5% deposit scheme, which means that the people taking it on are being responsible and they are using that scheme well. So this has helped a huge number of Australians to get into a home, and we're really proud of that scheme. But it's the view that we took in this budget is that it's not enough. That scheme is helping young people to buy a home, to take on a bigger debt, but we needed to do more. We needed to build more homes. We needed to level the playing field with investors. And so that's why we've supplemented that program that came through last year with these measures to really level the playing field and make what we think will be a really big change in the housing market.
Excellent. And I will point out that we've had 1,500 locals in Jagajaga use that scheme to get into their first home. So that is really important, I think. Jenny from Montmorency is asking about EVs. She's asked, how will the government balance budget savings from changes to EV tax incentives against the need to accelerate the transition to cleaner vehicles? This is important as EV sales increase with overseas events. And Andrew, I'm going to add that you might have seen today some great reporting around EV sales going up. 48% of all new cars sold in the past month were EVs, which is a real, I think, shift.
That's amazing. Yeah, it's incredible.
Yeah. So for me, actually, with my special envoy for climate adaptation and resilience hat on, I think it's great to see those numbers coming through. But do you want to talk about the incentive there as well and the interaction?
Yeah, I mean, you're probably closer to this than me, Kate, but the government's been really keen to support people on their electrification journey, whether that be batteries or EV incentives or other things. The EV incentive has been really popular, particularly with people whose salary package. So we're continuing that, but we're just tapering it over time to apply to some of the less expensive vehicles. But it's certainly been a program which we think has been very beneficial, helping people into EVs, and now we're really starting to see that EV demand snowball. I hadn't seen the data that Kate was talking about, but that is just an extraordinary number, and great news for people who are saving money, and great news for our energy transition as well.
Yeah, it absolutely is, and I think to your point, yes, we've extended that scheme, so it is still there. It is now going. It will start applying to cars that are at the cheaper end, but that's also, I think, where we're seeing the uptake in EVs as well, because the models are getting cheaper as they get more prevalent. So that's a good thing as well. Together with our cheaper home battery scheme, which I should also mention, obviously, again, helping Australians electrify. We've had more than 400,000 households across Australia take up that program since we put it in place July last year, which I think again goes to how people at a local level, at a household level, are seeing this opportunity around electrification in terms of their cost and what they're paying on their bills. All right, we have Simone from Viewbank, who has asked what measures in the budget will encourage greater investment in new housing supply.
Well, great question, Simone. We are doing a ton on new housing supply. Really the problem that we've had in Australia is just a 30-year underbuild. We have not been building enough houses. We've had massive incentives for people to plough their money into existing homes, and just not enough incentives and capability around new builds. So we're tackling this from almost every angle you can imagine. One big way that we're tackling this is by doing what we described earlier in this call, which is concentrating that negative gearing benefit on new builds. So saying if people want to take advantage of this negative gearing opportunity, which a lot of people do, you have to be investing in a new build home. So that is going to create a lot of demand for new builds. The second thing that we are doing is we have the very significant investment that we're making in Housing Australia, which is encouraging a range of new builds, particularly in affordable housing, and providing support for developers to bring on that new housing. And then in this budget as well, we also had a significant measure in order to encourage new housing to get off the ground by supporting some of the infrastructure. That often means that subdivisions and other new housing projects are a bit slower. So we're really putting our shoulder to the wheel here on new builds. We know that over the long term, just getting more houses built is what will fundamentally change the supply-demand imbalance and tilt that in favour of supply, which means that it'll be easier for young people to buy a home. There'll be more houses available, and that ultimately is the long-term solution here. So supply has been this government's mantra, and there's a lot in this budget to advance that objective.
Yeah, I think that's right. And we have some of that supply being built locally as well, which is fantastic. I think, again, if we think about some of the local services we enjoy, and we've already talked about the Austin Hospital and how important that medical precinct is, we want to have housing in the area that allows people who work in that precinct to live in the area as well. And some of the affordable housing that's going in, some of the build to rent options, I think are going to be really important as they come online locally in the next few years. I've got one that is probably pretty relevant to that, from Bryce from Greensborough, who said, as a young person saving for a house deposit, how can I expect house prices to be affected by these changes, and how long is that likely to take?
Yeah, look, I mean, over the long term, um, building new houses means there are more houses available, and that supply ultimately means that houses are cheaper than they would otherwise be. There are other things going on in the housing market. You know, we've got changes in interest rates. We've got other impacts flowing through in terms of construction costs. There's a lot going on in the housing market right now. But ultimately, over the long term, building more houses will provide more affordable options for people. Short-term fluctuations are hard to predict, but one thing we know is that the more houses that we build, the more affordable houses will be. And that's what we're really focused on.
Excellent. Harry from McLeod, in light of growing tensions overseas, how's the government using this budget to build a more self-sufficient energy system? I note the gas reservation, which is fantastic. Should I have a first crack at this one, Andrew, and then hand over to you?
I think you'd be better placed than me to answer this one. Yeah.
Again, putting my special envoy for climate change, resilience and adaptation hat on. Certainly, I think one of the big features of where we are as a country at the moment is our opportunity and ability to build our renewable energy supply. And Harry, you're absolutely right that really goes to resilience and to our sovereignty actually as a country. So I mentioned before the cheaper home batteries scheme. We now have the highest uptake of rooftop solar in the world in Australia. And the battery scheme is really complementing that and allowing people to take control of when they're using that power and to bring their energy bills down. As you've noted, the gas reservation scheme, you know, gas is going to be part of our energy transition. It is part of backing up the system to make sure that we've got continuity of supply. But one of the interesting things that's happening in the electricity market at the moment is that gas is playing less and less of that role. It used to be that there were quite a number of times when we needed gas to come in and back up the system. That is actually coming down as we get more renewables online and we get more battery storage online, not just household battery capability, but also larger scale industrial capability. So we need more of that, and that's really where we're putting the focus on our investments through things like our investments in clean energy and the spaces there. It is, I think, driving ahead in a way that is good, where we are seeing that really strong uptake at a household level. And I think that story around and that understanding for people that it gives them that certainty and control in their own household is a really important one, and one that we'll see continue to play out. Anything else you wanted to add on that one, Andrew?
No, I'll defer that one to you.
Yeah, fair enough. And Tim from Rosanna again, with the uptake in AI use in large corporations, could you comment on whether we're seeing any large shifts in employment and redundancies, which might be an overall risk to employment?
Yeah, really important question. We are certainly monitoring the impacts of artificial intelligence on jobs really closely. And there is no doubt that artificial intelligence could have quite a big impact on the tasks that we do in our work, and that could flow through to some big impacts on some jobs. And everybody can see in their daily life that this technology can do some things really well, including some things that currently jobs for lots of people. So that's something that is being watched really closely by the government. The evidence we have at the moment is that there are some categories of jobs which appear to be affected around the world by AI. The sort of the first types of jobs that are being affected. Some of the ones that get mentioned really frequently are jobs like coders and software engineers, because the AI is actually quite good at doing that coding and that software engineering itself. So we're seeing some of the big technology firms around the world lay off some of their coders. But AI is also creating jobs, because those big firms that had big teams of coders, maybe they need a few less coders. But we're not seeing those coders arrive on the unemployment queues at this stage. We're seeing them being reabsorbed into the medium and smaller firms, which now they also want to use AI. They've never been able to, buy a big team of coders or pay for a big team of coders. But now with a small team, you can do a lot with some of these tools. So we're seeing a reallocation in the job market in some of these highly exposed jobs. So far, that reallocation is not leading to big increases in unemployment across the board. And there are quite a few job creation opportunities that come out of these technologies. But the government's monitoring it really closely. We're very conscious that some of these impacts could gather pace. And we're certainly ready to manage that transition as it begins to occur.
I think that's so important, and it can feel, I think, quite scary at the moment in terms of what those changes might mean. But that principle around how we are both looking really carefully at this, but also working to make sure that it works for Australian workers, I think, Andrew, is a really important one. Michelle from Eaglemont, after decades of rising housing costs compared to wages, what else might the government do to rectify this, in addition to the long delayed but welcome changes to CGT and negative gearing? We've just made these ones, Michelle, but it's good that you want us to do more. This measure will likely slow the continued disparity between wages and housing renting costs, but will not affect affordability in the short to medium term. What are your thoughts?
Well, I mean, you're right that we need to do more. I mean, this is not a challenge that you fix quickly. This has been a challenge that's been building for decades, and it's a challenge that will take some time to solve. We think these measures are the right measures to solve those challenges, but we know that it's going to be a long effort. Building new homes takes time, particularly building the number of new homes that we need. Making these changes in the tax system, partly because they are there are transitional arrangements in place, means that they will take time to have an effect. But we think these are the right changes, and we think that just as this took a long time to become a big problem, we can at least show people that we are heading in the right direction, and there is light at the end of the tunnel in terms of that dream of Australian home ownership, and young people can aspire to that dream. So there's definitely more that we can do, that we will do, and a lot of these things will take time to implement. But for the first time, we feel like we have the opportunity to be heading in the right direction towards higher rates of home ownership amongst young people, fairer outcomes across the board, across different asset classes, across different types of income and the way that those are taxed. So there's more to do. What we have done will take time to have an effect, but we feel confident and proud in this Labor budget that we're doing the right things.
Thank you. I think that's actually an excellent spot for us to be finishing on. As we said at the start of the presentation, I do think that these changes are ones that will be important, not just for those first home buyers who hopefully now will have that better chance of getting into a home of their own, but for all of us, because we do want to live in communities where that housing option is available to people who are working hard and having a go. We do want to live in communities where the people who work in our communities can afford to live there. So I think this is important on a number of fronts. Andrew, I really appreciate you giving your time tonight and taking on some of those quite complex questions for us. Thank you so much for that. Thank you to all the community members who've joined us, who have engaged with me. As you can see, I take your feedback with me here to Canberra, and I talk with people like Andrew, with the Treasurer, and with other ministers and other members of the government about it, and it does help us shape how we do this work. So I really appreciate all of you joining us tonight as well.
Great. Thank you very much.
Thanks, Andrew, and good night all.